Saw a scenario recently where an individual making 80 grand got their effective tax rate down to just 3%. Is this a good idea? Guys, I wouldn't recommend it. I'll tell you what I would recommend instead. That and more coming up. What tax bracket are you in? Do you know what tax bracket, if someone asked you, Jay Leno style sidewalk interview, what tax bracket are you in? Would you know? Deeper, would you know your effective tax rate? I know my tax bracket. I don't know if I could tell you just from memory what my effective tax rate is. So here's the difference between the two. And this is why it's important to know this stuff, even though you don't need to be a financial geek or tax geek like me or your CFP. So on your tax return, all of your income is added up. So wages and interest and IRA withdrawals, all that sort of stuff. And then you got that total income, and then you start taking deductions. And you deduct IRA contributions or any overtime that was deducted or whatever. And then your standard deduction or itemized, and that gets you to your taxable income. And that taxable income starts filling up tax brackets, right? So for married filing jointly, the first $24,000 and change then of that taxable income is taxed at 10%. From 24 and change up to about 100 is taxed at 12%, and so on, right? That starts filling up tax brackets, okay? And your last dollar after filling all of them up, okay, my last dollar of income was in the 22% tax bracket. Therefore, you're in the 22% tax bracket, even though not all of your income is taxed at 22%. But effective tax rate, what effective tax rate really is okay, well, now take that amount of tax that you paid and divide that into your gross income. So what's the actual tax you paid compared to the gross income before all your deductions? Well, I saw someone doing that math and in my opinion, took it too far. Here's a scenario. This is a single individual, so not a joint tax return, single filer, making 80 grand. And here's what he said. I was bragging about, hey, I was able to get my taxable income, my effective tax rate down to 3%. So on my 80 grand, I contributed the maximum amount to my 401k pre-tax, $24,500. I then contributed the maximum amount to my traditional IRA, the pre-tax one, $7,500. And then I have an HSA eligible high deductible health plan, so I contributed the maximum amount to my HSA, which that is pre-tax. And therefore, that got my $80,000 of income down to around $43,000. I then get the standard deduction, which is just over $16,000. And therefore, I'm only paying tax, even though I make 80, I'm only paying tax around $27,000, $28,000. That puts me into the 12% tax bracket. But the actual tax, when I math that out, is around $3 grand. $3 grand of tax on 80,000 of income is 3.8% effective tax rate, and he's high-fiving. Well, that sounds great, right? In a vacuum, that sounds great. But here's the problem. Of those three contributions, the 401k, the IRA, and the HSA, only one of those actually avoids tax. The other two delay it. And I'm not saying the other two are then bad ideas. I'm just saying, well, in this scenario, do you want to delay the tax or do you want to avoid tax? I'm about avoiding taxes, okay? And I want you to know, well, is right now in my circumstance, how much tax should I defer and how much or delay and how much tax should I avoid? Because instead of taking this scorched earth sort of approach where, listen, everything I fund is pre-tax because I want to get today's taxable income as low as possible, even if that means I pay more tax in the future, I'd instead do two things. Now, before I share that, let's just ignore the fact that, listen, on 80 grand, can you really fund all of these things? Let's assume that you can. Maybe you've got some inheritance dollars, some other dollars. I have no idea. But let's set aside the shocking attempt to say, well, really, at 80 grand, you can max your 401k, HSA, and IRA, really? Let's assume that you can. Instead of taking the approach that this individual did, I would definitely max out that HSA. You get that deduction on $4,400, that's fantastic. The tax on those dollars is avoided as long as you then withdraw the dollars for a qualified medical expense out there in the future. You got a tax deduction on the way in and it's tax-free on the way out. And by the way, any investment interest growth on those dollars, that's not taxable either. So HSA, absolutely fund. But then I would consider maxing out my Roth side of my 401k, paying the tax today, but never paying the tax on that growth ever again, and maxing out my Roth IRA. Yes, in that scenario, you're a little bit into the 22% tax bracket as a single individual making 80 grand, funding your pre-tax HSA, funding that HSA pre-tax, obviously getting the standard deduction, still in that 22% tax bracket. However, those dollars then are growing tax-free forever. That's one scenario. And if you say, no, I'd rather optimize, and I like this, guys, I like this, then scenario number 2 is you max out that HSA, but then you contribute just enough pre-tax 401k to get you to the very top of the 12% tax bracket. Avoid the 22, get to the top of the 12% tax bracket. And then after that, once you're there, everything else in the 401k is Roth, and then you max out your Roth IRA. So in that scenario, you'd fund your HSA pre-tax and you'd contribute about 9 grand, a little bit more than 9 grand pre-tax to your 401k. Everything else would be to the Roth side of the 401k, and then max out your Roth IRA. In that scenario, you got your $80,000 of income down to keep you in the 12% tax bracket, and you deferred or you delayed tax and avoided the 22% tax bracket while also having as much money as possible paid tax at 12%, but grow tax-free for the rest of your life, if not multiple generations. The point is, knowing your tax rate, but also your effective tax rate, as well as the levers that you can pull to optimize your tax picture, helps you with tax strategy. Your certified financial planner, looking at all 6 areas of your financial life. Tax planning, so tax strategy, that is one of the 6 areas of your financial life. Not tax preparation. Everyone needs to do that. That's reactive. No. Tax planning is proactive, looking at opportunities, looking at your situation to determine, does it make sense for you to fund everything pre-tax? For many people, it doesn't, okay? Not everyone, but for many people, it doesn't. Instead, should you do Roth everything, or should you optimize like that last scenario? Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us here as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.